Good morning. This is Professor Bolt, and this is an Exam 1 Badm211 test review for February 16th, 2020. I'm linking you to my desktop and the review that I have listed in each section that's found on SitLearn. So the first thing I want to show you is a few of the useful tools that I think everyone should go back to and refer to for studying. And the first one would be this financial statement that I have provided you access with. It's a quiz. If you haven't already done it, it's just the same thing that we'll be seeing, exactly similar format and everything on the exam, and that is preparing a financial statement from the list of accounts that you see here. Let me pull it up in a good view. You have a list of accounts here for a construction company, and the request is to first prepare the income statement, and you should know that the formula, revenue minus expenses, taking net income down to the retained earnings statement, where you take your beginning retained earnings found here, add that net income from the income statement, subtract out the dividends found here to get your ending retained earnings, and then take that ending retained earnings and prepare a balance sheet with the formula of assets equal liabilities plus stockholders' equity. Again, knowing that stockholders' equity is going to be part of it coming from the retained earnings statement. So I'm going to close this down, go back into SitLearn, and just show you a couple more of the important, helpful tools that you can use. Here's one on a video that I prepared.
Let's talk about the formulas for the three financial statements. These formulas must be prepared in order. The first financial statement.
And I would suggest that you watch this. It's very, very similar to what we do in class. Here is a PowerPoint that you can watch that shows you how to prepare the financial statements. And you've seen me use it in class, but I think it will be very helpful for you. Again, let me switch out my display. There we go. And this is the one where we talk about how you exactly prepare a set of financial statements. So my strong suggestion is that if you're having any troubles, go back to this, because it's 18 to 20 points on exam 1, and there really isn't a reason for a student to miss this piece. And it's crucial that you understand how these financial statements connect before you move forward to the rest of the course, to Chapter 2 exam material and the second sequence of events that we have. Let's see what else I've got on here. Chapter 2 doesn't really have any extremely helpful events in there. It's got some old quizzes and things. Chapter 3, similarly, here is a pincast that you might be able to access. You'd have to load the pincast software, and a couple of you have already said that you've done it. And I'm not going to get it started because I, quite frankly, am not 100% sure it's loaded on my computer, although I can try real fast. I'll pause and see. Okay, here we go. I downloaded this pincast into the LiveScribe player, and there's a video on a tab on SitLearn that helps you to understand how to use this. So let me show you how it works. I'm going to click play, and you will hear my voice and see my pen strokes, very similar to what I'm doing now.
This pincast is on the statement of cash flows. This is a chapter in managerial accounting related to the fourth financial statement. As you may recall, there are three financial of retained earnings, which prepared accrual basis actually starts with the...
Okay, and I show that to you because I had to download as a PDF. It's a PDF file that you have to use Adobe Reader with, and I plugged it into my the Pincast reader for each of you to use. And so I think that will be a helpful resource for you if you're interested in using those Pincasts as a study tool. So we're back. Exam 1, I've gotten a relatively detailed list. I won't always give you this much details, but I'm wanting everyone to be successful in this one. First, we're going to use a live statement of cash flows. And I've pulled up a live statement of cash flows. These are the questions that I want you to understand. So go through this bulleted list. I have Walmart's pulled up here, And as you can see for Walmart, sorry, let me scroll down, wrong financial. As you can see for Walmart, this is 2019, actually January 31st, 2019. Their January 31st, 2020 has not yet been issued. Here's our three categories, very clearly shown here. And in each one of these categories, we have net cash provided by operating activities. That's a crucial number right here. Down here we have net cash used, so it's a negative number because they spent more money on investing. And it looks like they bought something for $14 billion. I'm not sure what. I think it was Jet. Have to go back in and look at their financials for that year. And here, Jet, by the way, is an online processing business that they bought. And it looks like they also used up money in their financing area. And I can dig in each of these areas and see what happens. Let's start at the bottom with the easier one. They borrowed $15 billion, and I'm guessing that's to buy Jet. And they repaid some debt. Down here, they paid a lot of dividends. And it looks like they repurchased a lot of treasury stock. Scrolling up for investing, again, here's that Jet, that huge outlay that we have there. And then when we go to the top, we can see that they're using the indirect method. If you don't understand what I'm saying, go back to your notes. They started with net income of $7 billion, and they have a tremendous amount of depreciation, which is always added back. And then throughout this category, we didn't discuss all of this. That's more for an upper level class. We come down to the fact that they had $27 billion in cash coming from operations. A big chunk of that is the some unrealized gains and losses that they have. But the biggest piece, as we've said, is depreciation, and that's what caused their income to skyrocket. When we come down here, we see that the change in receivables caused their cash flow to go down, so that must mean that the receivables went up $368 million. Quick pause here. Remember, this is always in millions. Their receivables must have gone up $368 million, which meant that their cash flow effect was that it went down. So hopefully you can take some time to maybe look at a live financial statement like this to try to understand what's in there. Understanding, too, that the bottom line here is that their cash went up $742 million from the beginning of the year to the end of the year, and that this is the crucial piece that we are focusing on. Moving forward, go through again this statement of cash flows list. Let's look at this question down here. I said you need to understand how retained earnings are increased from one accounting period to the other, and that was very simply that revenue makes it go up, and that dividends and expenses decrease retained earnings. So I'm trying to get everybody again to have a base level of memorization so that we can move forward in this intro class. Here's some more concepts important for exam 1 that I want to go over. We've already done these two, and we've talked about the elements of each one of these financial statements. In other words, what is in assets, liabilities, and stockholders' equity? So prepaid revenue, for example, unearned revenue is a liability. Prepaid expenses is an asset. We've talked many, many times about the fact that revenue sometimes is called sales or fees earned. Just about every single expense is going to have the word expense on it. We talked about the fact that not all companies pay dividends. Moving to the next bulleted list, the difference in current versus long-term assets. Typically, current assets are those that we anticipate to be used up, consumed, or turned into cash within the next year or less. Those are things like cash, of course, cash equivalents. We had that definition that you need to understand what a cash equivalent is. We talked about inventory. We talked about accounts receivable, and sometimes short-term marketable securities if the company plans to hold on those marketable securities, which means investments in the stock market, for less than a year. The 5 parts of a financial statement, I think these are very important for every student to understand, particularly with this annual report project that's going to be due at the end of the month. And They are found in a live annual report that would be issued by the Securities and Exchange Commission. Not sure how fast I can pull Walmart's up, but I was just there a minute ago, so let's see if my history, there we go, it's in my history. So this is what Walmart's live annual report looked like last year. We haven't pulled this one up in class yet. And as we scroll through, we can see it's called a 10K, required to be filed by the SEC. And here's their table of contents. Here, for example, is their financial statements. It will also have their footnotes, management's discussion and analysis here. The 5 to 10 year summary is in this selected financial data. I think the financial statements also include, in fact I know they do, the auditor's report, and that's the 5 parts. Back to our list. Single step versus multi-step. Remember that a single step essentially just says revenues minus expenses. A multi-step income statement is going to have gross profit as a subtotal. So multi-step means essentially lots of subtotals. And that can confuse students whenever they do common size analysis. I'm going to add that in here because I didn't have it on here. So common size analysis is putting everything into percentages, understanding that it's important that a number doesn't mean anything by itself. It's the relationship or the ratio. So common size analysis may be putting sales as 100% and everything else as a percent of sales. Looks like I misspelled this word, vertical, vertical. Horizontal analysis is looking at an income statement with the percentages, but vertical analysis is looking at last year versus this year as a percentage. We did both of those in class. I sent you the template for those solutions, and I think you'll find it much easier because there will be less numbers on the exam, but you will still be doing one here, just like you did on homework. These 2 concepts are left over from Chapter 1, so let me discuss them very briefly. Materiality means that in the financial accounting world, we really ignore smaller amounts that wouldn't have an effect on the user. So as an example, you've noticed financial statements are rounded to the nearest million. You've heard me say it doesn't matter if you're a couple of dollars off or a percentage off. That's because it's immaterial when trying to make a decision. In financial accounting only, not managerial. When we get to the concept of conservatism, that means if we have 2 options to prepare financial statements by, because you're going to find as we go through this course that frequently there is more than one option for preparing a transaction, then we need to choose the most conservative option. Working capital is simply a formula that has a pretty simple way to remember it. It's current assets minus current liabilities, excuse me, and that is equal to your working capital. Debt to equity is literally debt, which is your liabilities, divided by equity, which is stockholders' equity. That's a pretty simple formula for you to know about. You may have to show that you can do that one. Earnings per share, I'll try to take the most basic example. It's net income divided by number of shares outstanding. The PE ratio is the market value of the stock divided by earnings per share. And the current ratio is current assets minus current liabilities. So now, to an intro student, you're like, oh my gosh, I've got these things to memorize. But to most, it's pretty easy to think about the fact that your current assets and your current liabilities, when you take the 2 away, hopefully you're not negative. That means you have more liabilities than assets. Remember, we're talking about current, and that's crucial that we got that current in there. Working capital and the current ratio are very closely related. Debt to equity is such an easy formula to remember. Earnings per share is the earnings, which is net income, per share, which is number of shares. That one's pretty self-explanatory. And so is the PE ratio. The PE ratio is saying what's the market value of the stock, what's the price of the stock on the market, divided by E, which stands for earnings. Finally, well, we've got a few more down here. Profitability versus liquidity versus solvency. These are three categories of ratios, and I just realized if you looked in the outside binder of your textbook, and I'm hoping that all of you took the time to buy the $10 hard copy version that you can rent and return, because it is a lot more easy to use, and I know from having tried to use e-textbooks as well, they just not have that quickness to them. Profitability tells you, is my company making a profit? Liquidity, can they pay their bills? Solvency, are they solvent in the long term? Do they have enough assets in a continuing business to be able to pay their long-term debt? For obvious reasons, I'll skip this one. And I will skip this one because we've talked about that. We can look at a company's financial position and say, they look like they're liquidating, or they look like they're borrowing lots of money, or wow, they've got some really strong cash flows from operations. If we move back to Walmart, I don't know if I can link here or not. Nope, not linkable. If I come back to Walmart real quickly, I can analyze them pretty rapidly, because the first thing I see in their statement of cash flows is that they have $27 billion in cash from operations, earning $7 billion. Now, it wasn't as strong as the prior 2 years, and I know from having studied their financials that they invested a lot of money into online sales and they didn't do so well with it. As you can see, it has really hurt. I think we see a stronger position in 2020. But notice their cash flows were strong. And you can see the one number on all of these that shows that they had tremendous amounts of depreciation because they were acquiring assets. And that depreciation expense is the allocation of those assets. When we look at investing, we can see how much money they've been spending on purchasing property and equipment and other businesses. And when we come down here to the financing area, the first thing that jumps out at me is that they have spent billions of dollars in repurchasing their own stock. That reduces their earnings per share, which makes their PE ratio look better, which gives the perception that they're stronger. It also makes the stock values go up, which is making the shareholders happy, in addition to the fact that they pay pretty strong dividends. So they pay less dividends as well. If you notice their dividends have been steadily declining, it's because they have less shares of stock outstanding. And then as far as what's going on in their cash, let me say this as a final statement for those of you that are going to be working on the annual report project, which is the whole class. How much cash they have in the bank is really not indicative of anything, because that means that they're not really investing their cash wisely if they're too cash heavy. So as you can see, they're in around the $7 or $8 billion range. Obviously, right after a holiday, the winter holiday, they've got stronger cash than they might have at other times of the year. So that should be a quick rundown of analyzing a company's financial position. Finally, leverage, one of my favorite pieces, using other people's money, which means companies will very frequently borrow money and based on their strategy, use it to buy other things. Maybe when they bought that company called, I believe it was called Jet for Walmart, or to pay down debt, or to possibly buy treasury stock so that they can reissue it or so they can make their financial position look good. So the homework was due on Friday, so in order to allow you to study on Saturday and Sunday, and I know a lot of you have because you've been sending me messages. Good luck with this exam, and I look forward to seeing you possibly tomorrow morning. Bye.